Hey everyone, Daniel from Infovest here. Just want to talk about a couple of things that's been going on. Didn't get a chance to do a video, but I'd like to talk about the Consumer Price Index, which is the inflation metric that measures inflation, tells you how prices are doing. So we got the number that came out on Friday, and I'm just gonna here show you, just share my screen on the bls.gov website. So we have here, this is from the government coming here, Bureau of Labor Statistics coming out with the Consumer Price Index summary for the US, right? So if I go through here just quickly with you, you can see here that the increase of the inflation was broad-based, with the indexes for shelter, gasoline, and food being the largest contributors. After declining in April, the energy index rose about 3.9% over the month, with the gasoline index rising 4.1% and the other major component indexes also increasing. The food index rose 1.2% in May, as the food at home index increased by 1.4%. So first things first, that when you take a look at this paragraph and you read about it, right, inflation was broad-based, right? So it wasn't in specific areas, even though they mentioned a couple of areas, but it was broad-based and you saw inflation increase everywhere, right? Prices increased everywhere. Now the big components of all of this was shelter, where you live, gasoline, food, three most important essentials when it comes to living, right? You need a place to live. Rent is increasing, housing prices in terms of getting a mortgage now is increasing as well, right? I was reading somewhere that mortgage rates in the US are now about 6%, and it hasn't stopped there, right? We have the Fed that continues to increase their interest rates. That's also going to push up mortgage rates higher, especially as the 30-year yield continues to rise. Definitely not looking good. Another thing, gasoline. You need to get to work. You need to go and get to the grocery store to purchase food, right? It's funny. You have higher gasoline prices to go and do grocery shopping at a place where it's going to cost you a lot more to eat and put food on the table, right? Three of your most essential things that are increasing in your daily life: your shelter, your gasoline, and your food, leaving people with less amount of money, disposable income, to buy other goods and services. That's why the demand will fall quite a bit on luxury items and on items that are not needed, right? If you look at it, the items that you need will continue to see higher inflation because people need it. People need to eat. People need to live somewhere, right? People still need to fill gas in their car to get to places, whether they're trying to get to the grocery store or to the hospital or to their job, right? That will still continue to be an issue, especially when you have tensions that are rising, that continue to rise, and between Russia and Ukraine, and you have also the supply constraints that continue to be an issue that is inflating these prices higher, right? So again here, the index for all items less food, energy rose 0.6% in May, the same increase as in April, while almost all major components increased over the month. The largest contributors were indexes for shelter, airline fares, used cars, trucks, and new vehicles, right? Things are opening up, summertime, you need to get work done. These vehicles, these cars, if you want to go purchase, a new car or used cars, then definitely you'll see that the prices are still elevated, right? Airfares, right? Airline fares, right? So there was just a holiday recently in the US, and people were going out and spending their money less on goods and those luxury items, but more on kind of experiences, which are the services. So taking flights out to go on maybe meeting family or some sort of mini vacation and whatnot. So airlines have seen their fares increase. They couldn't meet up with the demand because of the labor shortages and whatnot. So they also saw their prices move up. And then also shelter again, which we talked about before. The indexes for medical care, household furnishing and operations, recreation, and apparel also increased. right? Now, a big part is medical care. You do need medical care. Medical care is very important. That continues also to rise as well. So if you're looking at it, putting everything together, your essentials are rising in prices. Definitely, it is hurting the wallet. It is hurting the pocket. It's breaking the bank. So the all items index increased about 8.6% for the 12 months ending in May, the largest 12-month increase since the period ending in December 1981. Right, this is a huge increase since 1981. All items less food energy index rose 6% over the last 12 months. The energy index rose about 34.6% over the last year. Right? You see energy prices over 1 year has increased 34.6%. This is the largest 12-month increase since the period of September 2005. And we see oil prices today, right? They're at 120, right at 2008 levels, right? So the largest, so that's the largest increase. The food index also increased 10.1% over the 12 months ending May, and the first this is the first increase of 10% or more since the period of March 1981. So when you look at it, right, the food index, the basically the energy prices, they're all increasing to levels that we haven't seen in a very, very long time. So now if I scroll down here a little bit and we look at all the items here, you can get a good idea what the unadjusted 12 months ended for May was like. And you can see here energy has risen to 34%. You're looking at food at 10%. And let's take a look at utility, right? Utilities have been increasing as well quite a bit, right? 10% as well, right over there. Electricity, 12%. Let's look at this. New vehicles, used vehicles, 12, 16%. Transportation services, you need to take the bus and etc., increasing as well, right? All of these are services that we all need quite drastically in order to, utilize for our daily lives, right? All of these are very essentials. These are all essentials we need. And if we are putting majority of our money in these essentials and these essential prices continue to rise, right, then definitely it's going to create a lot of pain for consumers who, if their salary and wages are plateauing, because you can expect that corporations are not going to increase people's wages and salaries unless like they're having a hiring problem. Actually, what's happening is now you're getting people to lay off workers because the cost continues to rise, and they can't continue to support employees who, because the demand is starting to fall with all of these higher prices and higher interest rates that are happening, right? But then now, what's expected to happen with these prices as interest rates increase? The idea is that as interest rates increase, you should expect that these prices to come off. Now, at what level will these prices come off to, right? When will these prices come down to? Well, when we look at here, just looking at the data, let's look at the CPI year over year. Let's first look at that, and then we'll look at the core CPI year over year. So first one, here it is. Look at the year over year number CPI. It's 8.6, right? And look at last number's peak, which was around April, which was 8.5. We basically beat by a little bit, by 0.1%. So we haven't completely, made new lows in terms of the CPI. We didn't really peak, I would say, on the headline number. It did make a new high this month, right? And compared to the last couple of data points, right? We were here at 8.5, and then we got 8.3, and a lot of people were saying that inflation was peaking, right? Maybe this number could be the number where we peak now at 8.6, because it's not a drastic jump. It's not like we went from 8.3 to 9%. We are getting close to it, but it is not as strong as compared to the peak of 8.5%. It's just a very small little jump. It is a jump from May till June, but not a drastic one, right? So will inflation peak? That's the question. And what will it take? Will it take the central bank and the Fed to continue to raise interest rates? Will they do that? And if they do that, then sure, maybe you might see prices come down, but possibly in certain sectors and certain areas. But when it comes to food, we're getting a food crisis, food shortages happening. Look at what's happening in Sri Lanka and many other countries, right? They're having problems of importing, certain, let's say, um, fertilizers to continue to feed their country, right? There's certain, stories also in the US where manufacturing plants are shutting down, which has to do with also packaging and manufacturing food and putting food on the shelves in the grocery stores. That's also starting to shut down. So if you've got shortages in a certain area, like for example, food, and you've got interest rates rising to bring down prices, but prices are rising, interest rates are rising, and the consumers have no amount of discretionary income, disposable income to basically take that and buy other goods and services, then sure, probably the prices on the other services will come down while maybe food may continue to rise. And that may not still, raising rates may not still solve the supply constraints that are happening with food shortages. Especially also, same thing that goes with gasoline prices. So your essentials may continue to rise until there is a really dramatic move in terms of demand, a dramatic drop in demand, in terms of people trying to either one, cut down on how much they eat, look for alternatives in terms of food prices, look for other places to eat. If there's more supply of one, let's just give an example here. I'm just giving an example. Let's say there's more supply of, let's say, apples, for example, then probably people will push and move towards that area and buy more apples, since there's no pears or there's no oranges, right? Because there's a massive shortage, right? And then eventually, then maybe apples will start to fall in shortages, and you'll see the prices move up there, right? So the thing is, what I'm trying to say is that yes, you have the central bank increasing interest rates, which is going to hurt consumers even more. Prices continue to rise. Probably certain areas and sectors of the economy, you'll see it come down. But then when it comes to other areas like food prices and gasoline, they may continue to rise, especially if there's shortages. Now, with housing and shelter, when you have higher rates, it will kind of cool down. It should cool down the housing market, bring it down lower, because you have less people, less demand, less people taking out mortgages, which will mean that less people buying homes. So that should probably fix over the time. So we're going to have to continue to monitor and see what happens with data in terms of whether inflation is peaking or not, or is this the end of it, or we're going to see a continued rise. But there is definitely a lot of risk out there. Another thing is look at core consumer CPI year over year. This is a very interesting metric here. We're seeing the core number basically peak. So we saw the number around 6.5% in April, and then come down to 6.2 and 6%. So that's not bad. That's showing some signs that prices in some areas are coming down. But then when you look at the headline number, because of the oil prices and whatnot, that's keeping it elevated. So will we see inflation come down? It will have to do with the idea and the course of the path of what interest rates are going to be, where they're going to be in the future. And if that continues to be elevated, then sure, you could probably see demand completely drop, and you bring also prices coming down lower. Now, another interesting, comment that I'm hearing quite a bit is about secular inflation. Now, secular inflation meaning that we might see elevated inflation, even though inflation may come off from its peak about 8.6%. we might see secular inflation in the future due to all of these supply constraints that may continue to be seen in the markets, and may continue to also create uplifting prices. Um, and that's not going to be fully solved with just adjusting interest rates and doing QT, right? Especially if you're in a recession and the markets crash and the markets continue. I mean, we're already in a bear market and the markets continue to crash even more. Then definitely, if the Fed comes out and says, okay, we're going to start printing money, we're going to conduct quantitative easing, and you're at 8.6%, and you haven't reached to your 2% within that year or 2 year time frame, how are you going to get inflation lower if you start all of a sudden printing money again? So can we see secular inflation? Can we see higher prices to continue in the coming years? And this is going to be a battle and an issue that a lot of us are going to face in the coming years. We'll have to see. We'll have to see how the Fed and how central banks around the world control inflation. Could that mean that they're going to start ramping up rate hikes? Right? We're hearing already today. I'll probably try to post the article here in the description. We're hearing today, after the CPI report, of a potential 75 basis point rate hike, either this week or next month, a 75 basis point rate hike. And this is coming from Wall Street Journal, and another Wall Street Journal report coming out with a potential of a 100 basis point rate hike. This is getting more aggressive to fight inflation. You've heard it from Bank of Canada, you heard it from ECB. They came out and they also talked about that they want to fight inflation. Bank of Canada said they want to get to that above 3.5% in interest rates to really fight inflation and bring it down. Will the Fed say the same thing this week? Will they come out? Will they be aggressive? Will they do a 75 basis point rate hike this week? Or will they set the markets up for a 75 basis point rate hike next month? And then once you start tightening and tightening, imagine we are not even right now in the US, we're about 1.1% in interest rates. This week, we're expected to increase by 50 basis points. We get to 1.5%. Imagine we're already seeing the economy getting affected by all of this interest rate hike and higher prices. And you're seeing also, and 1% is considered to be accommodating. It's not restrictive. We haven't reached to restricted levels in interest rates. That's when we get above 2.5, 2.7, 3%, 3.5. Now we're talking about restrictive levels. We haven't even reached restrictive levels, and the markets are already being affected by it. Imagine what we do with a 75 basis point rate hike. Imagine what we do if we do a 100 basis point rate hike. Now, I don't think that, 100 basis point may not come this. I don't think 100 basis point will come this week for sure. I don't think a 75 basis point rate hike will come this week. I think they'll stick with the 50 basis point. We'll see maybe what data ends up being for inflation next month. And then if it still comes in pretty high, then you might see maybe a 75 basis point rate hike next month. So let me know what you guys think. Put in the comments below. Let me know if you think the Fed or the central banks around the world are going to tighten like we've never seen before and crash the markets down lower, or you think that things are going to solve on their own and we are not going to see secular inflation and things are going to be better. Let me know what you think. Comment below, and I'll see you guys around. Thanks. Bye.